International financial management. Discuss the complexities involved in international capital budgeting. Multinational capital budgeting has to take into consideration the different factors and variables which affect a foreign project and are complex in nature than domestic projects. The factors crucially in such a situation are cash flow from foreign projects have to be converted into currency of the parent organization. Parent cash flows are quite different from project cash flows. Profits remitted to the parent firm are subject to tax in the home country as well as the host country. Effect of foreign exchange fluctuations on the parent's firm's cash flows. Changes in rates of inflation causing a shift in the competitive environment and thereby affecting cash flows over a specific time period. Restrictions imposed on cash flow distribution generated from foreign projects by the host country. Initial investment in the host country to benefit from the release of blocked funds. Next, political risk in the form of changed political events reduce the possibility of expected cash flows. Concessions or benefits provided by the host country ensures that upsurge in the profitability position of the foreign project. Estimation of the terminal value in multinational capital budgeting is difficult since the buyers in the parent company have divergent views on acquisition of the project. Write a short notes on foreign currency convertible bonds. Also state what are the advantages and disadvantages of foreign currency convertible bonds. A type of convertible bond, foreign currency convertible bond, is a type of convertible bond issued in a currency different than the issuer's domestic currency. In other words, the money being raised by the issuing company is in the form of a foreign currency. A convertible bond is a mix between debt and equity instrument. It acts like a bond by making regular coupons and principal payments, but these bonds also give the bondholder the option to convert the bond into stock. Advantages of foreign currency convertible bonds. The convertible bond gives the investor the flexibility to convert the bond into equity at a price or redeem the bond at the end of the specified period, normally 3 years if the price of the shares has not met his expectations. Companies prefer bonds as it leads to delayed dilution of equity and allows company to avoid any current dilution in earning per share that a further issuance of equity would cause. Foreign currency convertible bonds are easily marketable as investors enjoy option of conversion into equity if resulting to capital appreciation. Further, investor is assured of minimum fixed interest earnings. Disadvantages of foreign currency convertible bonds. Exchange risk is more in foreign currency convertible bonds as interest on bonds would be payable in foreign currency. Thus, companies with low debt equity ratios, large forex earnings potentially have only opt for foreign currency convertible bonds. Foreign currency convertible bonds mean creation of more debt and a forex outgo in terms of interest, which is in foreign exchange. In the case of convertible bonds, the interest rate is low, say around 3% to 4%, but there is exchange risk on interest payment as well as repayment if the bonds are not converted into equity shares. Ready short notes on American Depository Receipts. An American Depository Receipt ADR is a stock that trades in the United States but represents a specified number of shares in a foreign corporation. ADRs are bought and sold on US stock exchange just like regular stocks and are issued or sponsored in the US by the bank or brokerage. ADRs were introduced in response to the difficulty of buying shares from other countries which trade at different prices and currency values. US banks simply purchase a large lot of shares from a foreign company, bundle the shares into groups, and reissue them on either New York Stock Exchange, AMEX, or NASDAQ. The depository bank sets the ratio of US ADRs per home country share. This ratio can be anything less than or greater than 1. For example, a ratio of 4:1 means 1 ADR share represents 4 shares in the foreign company. What are the advantages of investing in ADRs? ADRs allow US investors to invest in the companies outside North America with great ease. By investing in different countries, you have the potential to capitalize on emerging economies. Disadvantages of investing in ADRs. ADRs comes with more risk. It involves political factors, exchange rates, and so on. Language barriers and lack of standards regarding financial disclosure can make it difficult to research foreign companies. Foreign companies. Next, write a short notes on Global Depository Receipts (GDRs). Global Depository Receipt is similar to an ADR, but is a depository receipt sold outside of United States and outside of the home country of the issuing company. Most GDRs are, regardless of the geographic market, denominated in United States dollars, US dollars, although some trade in euros or British sterling. It is not a different financial instrument as it may sound from that of the ADR. In fact, if the Indian company which has issued ADRs in the American market wishes to further extend it to other developed and advanced countries such as Europe, then they can sell these ADRs to the public of Europe and the same would be named as GDR. GDRs can be particularly helpful to those persons who are not resident of a country in which they want to invest. Because through GDRs, those persons can invest in the shares of the company without any problem, and hence it is a great alternative of investment for them. Prices of GDRs are often close to values of the related shares, but they are traded and settled separately than the underlying shares. Advantage of GDRs to issuing company: accessibility to foreign capital markets, a rise in the capital because of foreign investors. Advantage of GDRs to investor: helps in diversification, hence reducing risk. More transparency since competitors' securities can be compared. What is the impact of global depository receipts (GDRs) in Indian capital market? Since the inception of GDRs, a remarkable change in Indian capital markets has been observed as follows. Indian stock market to some extent is shifting from Bombay to Luxembourg. There is arbitrage possibility in GDR issues. Indian stock market is no longer independent from the rest of the world. This puts additional strain on the investors as they now need to keep updated with worldwide economic events. Indian retail investors are completely sidelined. GDRs or foreign institutional investors placements plus free pricing implies that retail investors can no longer expect to make easy money on heavily discounted rights issue or public issue. As a result of introduction of GDRs, a considerable foreign investment has flown into India. What are the characteristics of GDR? Holders of GDR participate in the economic benefits of being ordinary shareholders, though they do not have voting rights. GDRs are settled through CEDEL and Euroclear international book entry systems. GDRs are listed on Luxembourg Stock Exchange. Trading takes place between professional market makers on an over-the-counter basis. The instruments are freely traded. They are marketed globally without being confined to borders of any market or country, as it can be traded in more than one currency. Investors earn fixed income by way of dividends, which are paid in issuer currency, converted into dollars by depository and paid to investors, and hence exchange risk is with the investor. Write a short notes on Euro convertible bonds (ECB). Euro convertible bonds are quasi-debt securities, that is unsecured, which can be converted into depository receipts or local shares. Euro convertible bonds offer the investor an option to convert the bond into equity at a fixed price after the minimum lock-in period. The price of equity shares at this time of conversion will have a premium element. The bonds carry a fixed rate of interest. These are bearer securities, and generally the issue of such bonds may carry two options, that is call option and put option. A call option allows the company to force conversion if market price of the share exceeds a particular percentage of the conversion price. A put option allows the investors to get his money back before maturity. In the case of ECBs, the payment of interest and the redemption of the bonds will be made by the issuer company in US dollars. ECB's issues are listed at London or Luxembourg Stock Exchange. Indian companies which have opted ECBs issue are Jindal Strips, Reliance, SR Gujarat, Sterlite, etc. Indian companies are increasingly looking at euro convertible bonds in place of global depository receipts because GDRs are falling into disfavor among international fund managers. An issuing company desirous of raising the ECBs is required to obtain prior permission of the Department of Economic Affairs, Ministry of Finance, and Government of India. The proceeds of ECB would be permitted only for the following purposes: import of capital goods, retiring foreign currency debts, capitalizing Indian joint venture abroad. Discuss the complexities involved in international working capital management. A multinational firm has a wide option for financing its current assets. A multinational company has funds flowing in from different parts of international financial markets. Therefore, it may choose to avail financing either locally or from global financial markets. Such an opportunity does not exist for pure domestic firms. Interest and tax rates vary from one country to another country. A treasurer associated with a multinational firm has to consider the interest or tax rate differentials while financing current assets. This is not the case for domestic firms. A multinational firm is confronted with a foreign exchange risk due to the value of inflow or outflow of funds, as well as the value of import or export, are influenced by exchange rate variations. Restrictions imposed by the home or host country government towards the movement of cash and inventory on account of political considerations affect the growth of MNCs. Domestic firms limit their operations within the country and do not face such problems. With a limited knowledge of politico-economic economic conditions prevailing in the different host countries, a manager of a multinational firm often finds it difficult to manage working capital of different units of the firm operating in these countries. The pace of the development taking place in the communication system has to some extent eased this problem. What are the main objectives of international cash management? International cash management. Main objectives of international cash management. The main objectives of an effective system of international cash management are to minimize the currency exposure risk, to minimize overall cash requirements of the company as a whole without disturbing smooth operations of the subsidiary or its affiliate, to minimize transaction cost, to minimize country's political risk, to take advantage of the economies of scale, as well as reap benefits of superior knowledge. How the centralized cash management helps MNCs. A centralized cash system helps MNCs as follows: to maintain minimum cash balance during the year, to manage judiciously liquidity requirements of the center, to optimally use various hedging strategies so that MNC's foreign exchange exposure is minimized, to aid the center to generate maximum returns by investing all cash resources optimally, to aid the center to take advantage of multinational netting so that the transaction cost and currency exposures are minimized, to make maximum utilization of the transfer pricing mechanism so that the firm enhances its profitability and growth, to exploit currency movement correlations, payables and receivables in different countries having positive correlations, payables of different countries, different currencies, payables and receivables in different currencies have positive correlations, payables of different currencies having negative correlations, and pooling of funds allows for reduced holding. The variance of the total cash flows for the entire group will be smaller than the sum of the individual variances. Discuss the investment of excess cash or surplus by MNCs. Through a centralized cash management strategies, MNCs pool together excess funds from subsidiaries, enabling them to earn high returns due to the larger deposits lying with them. Sometimes a separate investment account is maintained for all subsidiaries so that the short-term financing needs of one can be met by other subsidiary without incurring transaction cost charged by the banks for exchanging currencies. Such an approach leads to an excessive transaction cost. The centralized system helps to convert the excess funds pooled together into a single currency for investments, thereby involving considerable transaction cost, and a cost benefit analysis should be made to find out whether the benefits reaped are not offset by the transaction cost incurred. A question may arise as to how MNCs will utilize their excess funds once they have used them to meet short-term financing needs. This is vital since some currencies may provide a higher interest rate or may appreciate considerably. So deposits made in such currency will be attractive. Again, MNCs may go in for deposit, foreign currency deposit, which may be an effective yield higher than the domestic deposit, so as to overcome exchange rate risk. Forecasting of forex Forecasting of exchange rate fluctuations need to be calculated in this respect so that a comparative study can be effectively made. Lastly, an MNC can go for diversification of its portfolio in different countries having different currencies because of the exchange rate fluctuations taking place, and at the same time avoid the possibility of incurring substantial losses that may arise due to sudden currency depreciation. Very short notes on international inventory management, or what do you mean by stockpiling? An international firm possesses normally a bigger stock than EOQ, economic order quantity, and this process is also known as stockpiling. The different units of a firm get a large part of their inventory from sister units in different countries. This is possible in a vertical setup. For political disturbance, there will be a bottlenecks in imports. If the currency of the importing country depreciates, imports will be costlier, thereby giving rise to stockpiling. To take a decision against stockpiling, the firms has to weigh the cumulative carrying cost vis-a-vis expected increase in the price of the input due to changes in exchange rate. If the probability of the interruption in supply is very high, the firm may opt for stockpiling even if it is not justified on account of higher cost. Also, in case of global firms, lead time is larger on various units as they are located far off in different parts of the globe. Even if they reach the port in time, a lot of customs formalities have to be carried out. Due to these factors, reorder point for international firms lies much earlier. The final decision depends on the quantity of the goods to be imported and how much of them are locally available. Relying on imports varies from unit to unit, but it is very much large for a vertical setup.